Hey, I want to go over a case study that I'm just wrapping up with a woman that I've been working with. She's a doctor on the East Coast, and she originally reached out to me because after decades of owning term insurance and just life experience as a physician, seeing people die unexpectedly, leaving loved ones with medical bills, she felt like having permanent insurance that would be guaranteed to pay out to her family down the road was a smart move for her. So she felt like she had a pretty decent retirement plan in place, but wanted to supplement that. But her main focus was having guaranteed life insurance. And so when she came across my book, Taming Wall Street, she liked what I had to say, and this was a way to kill two birds with one stone. Make sure she had that guaranteed tax-free death benefit if something were to happen, but then if she ends up living, having a way to either grow her wealth and legally avoid taxes, or be able to take a tax-free stream of income for the rest of her life. And so here's the case study, and let's just go through it. So this is the doctor's 10-year savings plan. She's 50-year-old female, and she wants to put $25,000 away for just 10 years. Now, she does not plan to retire in the next 10 years, but she just wanted to put money away for 10 years because at that point, she's guaranteed to have that death benefit forever, okay? As long as she doesn't deplete the money too quickly, that's guaranteed forever, and that money will pay out tax-free. Right now, she's in the very highest tax bracket in the United States, and she said to me, I don't like paying taxes now. And I said, well, then you'll hate paying them in retirement when you don't have a job anymore. So for $25,000 for 10 years, after 10 years, she has $298,356 that she could use, or she could just let it sit and grow. I'm going to recommend that she use it, but that's where we're at. She has just shy of $900,000 in death benefit. By the 15th year, she has $397,789 and just over $800,000 in death benefit. Now, I want to point something out because you may or may not catch this, but do you see that the death benefit is lower than it was in year 10? There's a reason for that. That has something to do with the way that I personally build these life insurance plans to maximize the amount of cash that goes into the plan versus how much death benefit you have. And so I won't go into too much detail, but I did want to point that out. And there's a specific reason for that helps you have more money. In the 20th year, she has $528,970. Now, imagine having $500,000 that is liquid. You don't have to pay tax on that. You can borrow that for real estate investments, cars, maybe you want to buy a family cabin, whatever it might be. And she has just shy of $1 million in tax-free death benefit. In the 25th year, $698,000, $1.1 million in death benefit. By the 30th year, she has $915,219, and she's got $1.3 million in tax-free death benefit. Now, she wanted to see this keep going. So by the 40th year, she's got almost $1.5 million. By the 50th year, she's got $2.2 million. But I let her know you do have some options. So yes, you could let that grow. And the death benefit's going to be even higher than that, by the way. But you could let that grow if you don't need the money. Because again, she has money going into a 403B. She also has money going into some other private investments. But this is how that money would grow. But I also pointed out to her that if she wanted to, she could take about $51,000 off for the rest of her life and not pay any tax on that. Now, that's equivalent to about taking $75,000 out of a 403B or a 401k and then paying tax on that and then having the difference. So what happens is you deplete your 401k or 403B faster than you want, plus you still have to pay tax on that. You must pay tax on a 403B or a 401k. There's just no way around it. And so with this, we've already built it in an environment that the IRS protects against taxation. And so what happens is if she were to take that, for 20 years, she's going to take out $760,860 during her lifetime. Now, she only put $250,000 into this, so she's now taken out 3 times as much money as she put in, and she's paid $0 in taxes. Okay? So now let's assume that she dies. Of course, there's still a healthy amount of death benefit, and that is also tax-free. So her total value to herself and to her family is $1,519,297. I mean, that's incredible. So what would your retirement be like if you couldn't lose money, if you got to grow that every single year, and you were legally protected by the IRS and from the IRS on being taxed? Okay? If you have one of these plans, I'd love to hear about it. Please put a comment. But this is what we're building for this woman, and she's very excited about it, especially because look at all the value she gets for just a block of 10 years of saving. And then we turn that off and we just let it grow organically. But there's no taxation happening. There's no loss happening. And she can either let it grow, or she could take a stream of income, or a mix of the two. She doesn't have to take it out. That's what's nice about it. There's no required minimum distribution at age 70 and a half, and there's no penalty if you don't access your money. It's there if you need it, and it's there if you don't need it. So it's kind of cool. Hey, go ahead and subscribe to my channel and make sure to hit the bell so that you're alerted to future videos. If there's anything I can do to help you today, please reach out to me at Stephen with a PH at yourbridgeplan.com. Otherwise, thanks for checking out today's case study.